Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Last week in the market, basically, we were dealing with a lot of economic reports. Had a major economic reporting week last week, mostly revolving around a few of the central banks out there, as many of you know. The first bank that really announced monetary policy was the FOMC, which is the Free Open Market Committee. That's the U.S. dollar. That's the Federal Reserve, or otherwise known as the Fed. That was reported on Wednesday at 2 p.m. Eastern Standard Time. And the reaction to the Fed was I guess, in the end, the Fed did what we all expected, and what we all expected was for the Fed to maintain policy, and that's exactly what they did. They maintained policy at 0 to 0.25% interest. They didn't really change anything outside that dramatically on their monetary statement either. Their monetary statement was very similar in comparison to some of their past monetary policy statements. They said they were going to take a fair and balanced, I guess they stole that from Fox News. They're going to take a fair and balanced approach to moderating interest rates, and changing their very accommodating or dovish monetary policy statement. But what I felt that was something that I was not expecting. And I want to make sure this is very clear, guys. If you, especially in the currency market, you do not carry swing trades through major announcements like the FOMC. You get out of those and you readjust into a news-based event, reassess after the fact, or you lower your position size, or you offset your risk with some other type of trade. In the stock and the options market, it's a little different because you're not dealing with the massive liquidity, the massive market that is the foreign currency market. So you want to be a little bit more conservative when it comes to getting into trades, getting out of trades before such a major announcement as the Fed. And we'll look at kind of how the market responded to the Fed here in just one second. But before we get into just exactly how the market responded to the Fed, let's talk specifically about how the Fed, this kind of statement itself. This statement, the FOMC statement, is not a normal statement like other economic reports are. You see, with a lot of other economic reports, like if we go to Forex Factory right here, with a lot of other economic reports, you have something that's called a forecast, and then you have the actual expectation. So if we just go to, say, the US dollar economic reports here, let's look at some of these ones last week. So here's building permits from last week. Came in at 1.11 million. That was the forecast. That is built into the market based on the efficient market theory. But it actually came in at 1.28 million. So that is a better than expected number. So if you go to the detail here, if the actual number is better than the forecast, it's typically good for the currency. And that came out at 8:30 a.m. Eastern Standard Time on Tuesday, June 16th. So if we go here to the dollar index, and we're looking up last Tuesday at right around 8 p.m., right there. Okay, so if we're just looking at this information here, do you see how at 6:30, right when this is reported, it kind of goes up in value? That's because building permits, it came in at a little bit better than expected. Now, the building permits is not a major economic report. Let's look at the CPI report here. The CPI report was expected to come in at 0.5. It came in at 0.4. Well, once again, if you don't understand kind of why that's important, then you click the detail button here, changing the price of goods or services purchased by consumers. If the actual is better than the forecast, it is good for the currency. Well, the forecast was 0.5. It came in at 0.4, so it shouldn't be good for the currency. And that was on Thursday, June 18th, same time at 6:30. So if we scroll forward to where we say June here, not June, but Thursday at 6:30, look at this big candle down right when the CPI report came out. I mean, you're talking, it went from 94 all the way down to 93.23. A 70 cents clip in 15 minutes on the market condition. That was all based on the CPI report. It's very fast. So as you can see, when you're dealing with these types of economic reports, they're automatically built into the market. They're very, very quick in terms of their building into the market. The FOMC policy statement is not the same way, because we certainly have this number, but we don't expect that number to change very much, since it hasn't changed in literally close to, what was it now, 6 years, over 6 years, when or actually closer to 7 years now, when they lowered the interest rate. So we don't expect this number to change very often. It's the statement that we have to be concerned with, and that's when Janet Yellen gets in front of the cameras and says, hey, listen, this is what's going on here, this is what's going on here, this is what we're doing, and that's when she gives her statement. And so if we go back to Wednesday here, as you can see, here's when the statement is, here's when the first announcement is released, and look at the whipsaw effect. Look at that, go all the way up to 95.6, and then over the next couple hours come all the way back down to 94, all the way down to about 94.20. So the marketplace really responded negatively in terms of the dollar, the value of the dollar, to what Janet Yellen was saying and what the Fed announced in their monetary policy statement, because they came across as very dovish. And that means they came across as an easy monetary policy, which means, more than likely we're not going to see an interest rate hike. At least this is what the market expected coming in. Most economic projections from national economists and whatnot still project a September rate hike. I am still projecting a September rate hike, but the market is not, because what happened is they took this statement as the Fed was not going to raise rates in September, and more than likely they're not going to raise rates till December of this year, and maybe even into 2016. And this is what the market is basically telling you, as they're selling the dollar here, saying, hey, listen, we don't have to worry about interest rates going up, so they're going to keep reinvesting the gains on their print and money purchasing bond program, otherwise known as the asinine quantitative easing program. But let's look at how the market responded to all this. This is the S&P 500 here. The symbol is dollar. The symbol is dollar sign. And let's remove the lines here. Dollar sign, not dollar sign, slash ES. So on Wednesday, looking at just this kind of report here, on Wednesday, this is where the market came out, and all of a sudden, look at the response. A very positive response coming into the market, but that's not even where it really started cooking. It really started cooking right on Thursday coming into the market, as the market started really kind of anticipating some of the market action. And right now, we're at 21.22 in the marketplace. The market really, really responded positively to the overall Fed last week. I've said this for a long time now. I'm going to maintain saying it right now. I think that is a mistake. I think the market is so used to free money, and I think the market is so used to quantitative easing, the Fed just gifting free money, that they are really being slow to react to a changing environment. And you came off support, you're back here at resistance. I don't see, despite what the Fed said last week, I don't see anything right now that changes the overall trend. I don't see anything that changes kind of the neutrality we're seeing in the market. Yes, last week was a really big week for the market. Golf clap. 2 weeks ago it was a really bad week for the market. I still maintain that we're going neutral right here, and we want to carry a neutral portfolio. So with that neutral portfolio discussed earlier, we want to look at kind of this week in the market, because that's kind of looking at last week. Now, a couple things we want to look at here. First of all, on the S&P 500, still neutral, but I do want to look at a couple other things very quickly. If we look at the Russell 2000, the Russell 2000 is small and mid-cap stocks, and as you can see, it's kind of broken out of its resistance area, that of 1280. It's currently at 1293, approaching an all-time high. Earlier, set an intraday high all-time. So we are seeing some strength in the small and the mid-cap index. Also, when you look at the NASDAQ here, we're just going to look at the NASDAQ 100, the NDX. The NDX is still neutral as well. As you can see, it's pumping its head up there on resistance, trying to break out of that resistance to set an all-time high. doji candle today. We'll kind of see where that leads us into the future. But right now, still neutral in the Nasdaq, still neutral in the S&P 500 as well. And then the last one I'm going to look at is the diamonds, which is the Dow 30, and the Dow 30 here still underneath those highs. So when we're looking at the four major market indexes, the strongest index right now is the Russell 2000, showing a lot of strength. With the second one, probably the other aggressive Nasdaq index, and then your blue chip index is doing a little bit of underperforming the market. Looking at the S&P 500, really in terms of bumping into those resistance, and probably the weakest index is that of the S&P 500 itself. And so we're looking at a lot of neutrality in the market, although it did have a really good week last week in the market. I'm looking forward to this week for a couple different reasons. Number one in the news is Greece. Greece is constantly in the news. They're coming into some very, very important deadlines this week regarding the marketplace, regarding the euro, regarding the eurozone, and we'll see how big of an impact Greece has to the eurozone itself. I'm not certain Greece can be a catalyst for the American markets. I just don't think it's. We already know kind of the depth of the problem over there, and the market hasn't sold. We've known for at least 6 months in the market that Greece was going to default, and many people, including myself, think that we already knew that about 4 years ago. Their debt problems just are too much, and they really can't get out of it with constant bailouts and whatnot. I'm looking for Greece to potentially leave the eurozone. I think it might be healthy for Greece to get back to some rational economic theory, default, hit the reset button a little bit. Again, I'm not sold on it being a catalyst for the world market collapse. You never know that. You never know when what's going to be the next Lehman Brothers collapse. Could Greece be that Lehman Brothers collapse? I'm not sold on it yet. I just not yet, anyways. I think there's some bigger fish to figure out right now in the marketplace. But I am looking to see how that the Greek discussion really impacts the euro dollar here. As you can see, the euro dollar has shown some strength over the last little bit, coming off the lows of about 105, currently at about 114. You're pumping your head up against some major resistance in the eurozone right here, right about I'd say top shelf, right about 115, but really that resistance level is between 114 and 115. Really kind of doji here, inverted hammer at the resistance level. If I was a gambling man, which I kind of am, I'd say the euro goes down from here just because it's at this very strong resistance area. But if you're going to take action on that, I would wait until the European markets open up later tonight to kind of see that price action right there in that capacity. Also this week in the market, we don't have a lot of economic reports like we had last week, obviously with the big dog FOMC, but you also had the SMB, you had the Bank of Japan, you had the CPI report, and you just had a major economic week last week in the market. This week in the market, you're only dealing with existing home sales, which came in today and had a good increase in existing home sales today. The forecast was 5.27 million. The actual number actually came in at 5.35 million. And so if you're looking at once again, if you're looking at the S&P 500 when that came out today, we're just looking at kind of this price action right here, and that came out about at 10 o'clock Eastern Standard Time, which is right here. And as you can see, the S&P 500, once new existing home sales came out, really responded very good to it over the next couple hours, going from 2115 up to 2122 before it started curtailing at that resistance level, coming back down in price. Still up 17 points off the highs, off the close on Friday, with a lot of that obviously coming in last night during the European markets. As you can see, it goes from 2106 all the way up to 2118. So a 12-point movement during the European hours. Then it kind of just hovered around until existing home sales comes out. FOMC member Powell gives a speech on Tuesday, as well as core durable good orders. That is a very important economic report coming in on Tuesday. But the only really economic report I'm fixated on this week is the final GDP number that comes out on Wednesday at 8:30 a.m. Eastern Standard Time. Now, for those of you who don't know what GDP is, it's gross domestic product. It's our national economy. If the actual is better than the forecast, which the forecast is a god-awful, dismal 0.2 negative growth for the final GDP for the first quarter of this year. I expect that to come in at a negative. I've been talking about that for 3 months in the market recaps, in the newsletters, in the podcast, and so many other aspects of it. And I don't see anything changing here. I do believe it comes in at a negative. I'm not sure about the second quarter, so we don't need to get all crazy and start thinking doomsday here because we're going into a recession. I do think the first quarter is a negative, but it has to be 2 consecutive quarters as well. And that this one's the final GDP, so it should be fairly accurate in comparison to the forecast, which is once again a negative 0.2. So that's kind of this week in the market. Hope you enjoyed the market recap for June 22nd. Looking at the S&P 500, the other market indexes, getting all you guys ready for the market this week. Matt Justice for Tackle Trading. If you like what we're doing over there at Tackle, go over there, become a pro member of Tackle Trading. See what we're doing in the coaches shows and all the scouting reports and everything else we do for our pro team members at tackletrading.com.